Welcome to today's session. Hope you're enjoying the summer so far, in full swing, and coming back inside to sit down to the computer. It's always interesting to go in and outside right now this time of year with the air conditioner on, and then go out to 100-degree weather and then back into air conditioning, and it's good stuff. Market conditions. Let's jump into these. We're still bullish in a bull market right here. Essentially, when I say that, what I'm talking about is we are bullish in the short term. That is this part of it, and we are in a bull market. In this case, this is as of yesterday. So in the shorter term bull market, we are in this uptrend in the shorter term. We're also in this bull market as this long term. The issue that we're running into right now is bull markets just don't last forever. We've talked about this, and we're approaching that phase where we've had, if I just draw a box around this length of time, I draw a box around this length of time, draw a box around this length of time, really all of the significant uptrends in the last 20 years and the length of time that we've got here. You can see now that this current bull market is approaching, or this obviously has been one really long bull market. We really haven't seen, other than 2 years ago, this counter trend move here, and then maybe COVID. COVID felt a lot worse, but it didn't last very long, just because of the world conditions. I think we talk about that often, to be like, man, when you think back in time, all of a sudden I go back to 2018 and 2019, 2020, 2021 kind of just got skipped over. And so we have this strange void in our lives, in our minds sometimes with COVID. But anyway, we that wasn't much of a correction. We got a ton of money pumped into the system, it created inflation, and now the counter trend of the inflation, and now we're dealing with the anticipation of lowered interest rates with the idea of AI improving productivity, improving profitability. And ultimately, in my opinion, those are the only two things driving the market right now, are the new technology of AI and the interest rates. Are we going to get interest rates moving flat, moving up, moving down? And outside of that, ultimately, as I've mentioned before, stocks pricing and stocks prices are the present value of the future earnings of a company. What's different, though, is because it's a marketplace, there is an intrinsic value to all companies, and that is, here is the XYZ value. Okay? You could call it book value, you could call it earnings value, whatever the valuation is. That's where we get all of these different methodologies and mechanisms on what is value. And then we all come in and we make our decisions. Oh, I think the stock is going up because it's undervalued, or I'm going to sell it because it's overvalued. But that determination of what value is subjective across the board. Everyone's deciding what that means. And so we overshoot to the upside because we're greedy and we anticipate and we want to speculate things going higher, and then things reverse and head lower for the exact same reason. It's like, oh, we're fearful now, and we're just going to sell everything, particularly once that starts. And those are the two things that create really the market condition. We're in a marketplace of bidding based on what we think the value of that company is. And that's what creates a marketplace, and that's why stocks go up and stocks go down. Ultimately, they will go up if profits are going up. If companies are growing and generating profits, that has to happen. When that doesn't happen, or anticipated that it's going to slow down, or variations of that, then the market's going to pull back. It's going to retrace, and then it's going to be a new adjustment to what value is. And that can happen. You can get a reset to be, these large institutions are anticipating that the Fed is going to be cutting. If that doesn't happen and the game changes, the information changes, the news items that we're dealing with, or that we're making our decisions based on change, then market conditions are going to change, because everybody's valuation or expectation of the future is based on something. And when that starts to reverse, stocks are going to go down. So currently, this is the phase that we're at right now, and this is where we're at, and have to make decisions based on the fact that we're very, very, very deep into this trend. It doesn't mean that we can't get any deeper and any higher, but what are the catalysts going to be? What's going to drive us above and beyond? It's just you know, the upside of this is starting to get a little bit more muted. That being said, it's not over yet, but we have to manage risk according to where the market is currently as well. You'll get lots of different discussions and lots of different arguments and lots of different methodologies and perspectives on this and why you should be doing what you're doing. Ultimately, when it comes right down to it, you've got to decide for yourself what your risk tolerance is, what your allocation towards equities is going to be, what the risk associated to that allocation looks like for you, and then understand essentially what the possibilities and probabilities are. Right now, you know, in a TradersPro methodology, we're primarily focusing on stocks that are going up. Okay, we want to see a stock that's moving higher. We use different mechanisms as far as trend analysis. We use Fibonacci analysis to help us, you know, determine at what point support's going to be found. But at some point, this trend is going to end. Okay, it's not going to last forever, whether it's a stock or whether it's a market. So primarily, in this case, we're focusing on the best of the best, the quality names that are moving higher, and at some point, those are going to correct and move lower. But again, the basis for what we're focused on are that companies and stocks are designed to go higher. They're built to go higher. They're not built to go to zero. When they do, why do we want to even consider it? We don't want any part of it. We don't even want to think about it. So why fight that? Why fight a piece of crap company that's going lower and try to buy their stock in anticipation that it might recover or it might go up? How long are we willing to wait for the company to figure that out? Versus, let's just focus on the stocks that are already working in the current market, and then look for opportunities to add into those and look for opportunities to profit from those. What we don't want to do is we don't want to get married to a name. Okay, we put names in our heads like Microsoft, Apple, Disney, and we say, oh, those stocks are amazing, they should go higher. Or what we're thinking is those companies are amazing, they should go higher. There's a big difference between a company and a stock, because you have a company that is managed by this management group, but the stock price is managed by all of us yahoos out here buying and selling, and as well as all of these large institutions that are determining what the valuation is. It is a free-flowing marketplace, and so the stock, a good company can have a garbage stock, okay? Not for very long, but it can be the perspective of that happening and moving lower. So we don't want, even if a good company is going higher and the stock is going higher, if that stock price starts to move lower, we don't want to hold it and take losses just because we think that Walmart is a good company or a Disney is a good company or Home Depot is a good company. In the really, really long term, that might be, you know, that's the buy and hold perspective, and that is I'm buying the company because I want to own the company. That's the Warren Buffett style. I'm going to own Wendy's and I'm going to own Hanes. You know, I'm going to own stocks that produce food and underwear and insurance because people always need that stuff. That's kind of Buffett's base mentality, is we're going to buy things that people always are going to consume, and we're going to buy the company. And he's always prepared to take major losses because he can afford to. Maybe not major losses. His allocations are always typically small in percentage of his holdings, but at a very basic level, that's kind of the idea. But we also want to participate in that to a degree. We're willing to sell it at a certain point because it's not working, it's not going higher. We're using these stocks as instruments for profitability versus long-term allocations of we're going to own Apple for the next 20 years or Netflix or whatever the case may be. We can certainly still do that, and would want to maybe have some of those ideas, or even better, trade around some of those ideas. If Apple goes into a downtrend, let's not be in it. If it goes back into an uptrend, let's be in it while it's in that uptrend. Kind of a little side note there. I'm going to get into that a little bit more here as well today, but market conditions, that's really what we're dealing with right now, is what could continue to propel the market higher. I shouldn't say that. We're not as interested in what could propel the market higher. We're more interested in is the market going higher, and is it strong in that movement, or is it weak in that movement? So momentum, we obviously know that price activity and momentum are our number one focus. That's what we want. We want to focus on the price activity. Is it going higher? S&P 500, if you look at this chart right here, okay, there is zero hint of downturn, at least as of yet. Okay, right now it's moving higher. We've got these 5 waves up. We're at the upper end of the trend, and it's now becoming, whereas price trend extended or is it not? And so then we can add some of these other things to say, well, we obviously know price is as high as it's been. And we also know that some of these shorter term indicators, when they get to these levels, they don't stay there, they retrace. But we can also see that there are times when they do get elevated and the price can continue to move higher. So we ultimately want to focus on price and then look for some of the edges to say, maybe it's looking for a retracement or a pullback. And then we can look for opportunities to be buying in on some of those pullbacks. And then the second factor of that is the breadth. What's the participation of this market? Okay, we have a 46 reading on this currently, which essentially means that only half of the market is participating. Less than half is participating in this uptrend. We also know that from the buy-sell ratio, which we'll go look at in a minute. And then sentiment, we know that sentiment is the greed fear factor. Okay, when we get really high readings like this, there's just no fear in the market. And so you'll notice this says complacency. Okay, complacency is what is happening right now, and that is nobody's scared of this market. Nobody's selling as of now, but it's every pullback that we get is being bought into, and that still should be our overall bias, but not with all the marbles, okay? Not with all of the allocation, not with all of our money. So when we're at different degrees of trend, then we can go into the marketplace with varying degrees of capital so that we understand that the risk levels are a little bit different at certain levels of trend. Okay, this is, you know, this is as high as this has been. Okay, this 20 pushing this 25 range, and particularly in this last year, even going back during this uptrend. But one of the things about this kind of this COVID uptrend that we saw was it stayed really kind of up and down and choppy and just slow and moving and kind of just grinding its way higher, and it did that for quite some time. So that could, you know, that could continue to happen here. Even though we're elevated, we could become even more elevated. As you may or may not have experienced, that can reverse. We can see one day wipe out weeks of this slow grinding move higher, and then all of a sudden, bam, we get one big nasty down day, and it becomes painful. So as we're not there yet, we want to prepare for that, but not prepare. What we're preparing for is what's happening right now, and that is the probability that this buy-sell ratio is telling the truth of the market. Okay, the S&P may not be telling the truth really. It's telling the truth of the S&P because it's a weighted moving average, but the market as a whole is quite bearish in that there are a lot of stocks that are not participating. That we also know that all of the stocks that aren't participating are generally higher risk type names. For example, Russell 2000 or Russell. Let me go to this perspective. Russell 2000 is in a downtrend and sell. These are small cap stocks. These are the smaller, more aggressive, more risky names. They haven't been working. They haven't been working really at all this entire year. You had a few little tiny ranges. Maybe back here where it was working, and it gave it all back and rallied up and gave it all back. So it's relatively flat versus looking at a chart of the S&P 500. So a big chunk of these stocks are in that buy-sell ratio, and they're just weaker names that are not participating in this current trend. That ultimately, for really strong bull markets to continue to advance, then typically we want to see broad-based participation. We're also seeing that in the sectors. Okay, the sectors, I do this every morning, so you're probably familiar with it if you're watching those, but it's essentially, this also tells us a bit of a story about the market participation. Okay, we had an attempt, a couple days ago, that moved a lot of these back to up, but a lot of them shifted right back to down, and then the ones that had gone from hold that were kind of hovering back and forth, they went back to this sell range. So this also, you can kind of just see that. There's a few winners, there's a few losers, there's a few stuck in the middle. That's what the market is right now. It's just not really bullish solidly or bearish solidly, but we're being moved by a group of stocks that do continue to participate in upside. And that's just what it is. Okay, whether or not it's good or bad or whatever the case is, that's we have zero control over the market. What we're trying to do is just read into these different areas, these different pockets of stocks, these different pockets of the economy with sectors, and saying, what do we have a high probability of things continuing higher? How aggressive do we want to be in that participation to the upside? My philosophy is making sure that we're well diversified within the right timing. Okay, so we want to be in the market when it is really, really hot. We've got buy sell ratio that's positive. We've got all of the sectors that are humming along right here, and we don't have, even commodities right now. We've seen gold and oil. There's been this flight to quality in gold, even though it's still kind of weakening. It's retraced, but we've had this big run up, dealing with interest rates and inflation and all these different factors. So those are just some of the things to be able to help us tell the story of the direction of the market. And that's really the most important part, is what direction are we continuing to go, so that we can continue to buy into that trend, but we don't want to do it with the whole wad. Okay, with the whole load of cash. We want to make sure that we're just being smart, so that 1 or 2 or 3 or 4 or 5 even trades that might move against us are not, they're just not a big deal. It's just not catastrophic. Okay, or we get a really big drawdown that's really hard to recover from. That's what a lot of stock traders experience, because they don't understand the amount of risk that actually is happening. William O'Neill said, and I mentioned this last week, that all stocks are bad. If you think about that, and you think about Apple and Disney and Walmart, all stocks are bad. All stocks can lose you money, just like they can make money. I prefer to say it another way, and that is that stocks are not good or bad. They just simply go up or down. And so, are we in the uptrend? It's going up. We want to be in. If it's in a downtrend, we don't want to be in that trend. It doesn't mean it's good or bad or the other. It just means it's trending. And we want to oftentimes tag our own perspective or our own opinion to our decision that we're making. Part of that is confirmation bias. We as human beings don't like to be wrong, and trading is a game about probabilities. We're going to be wrong probably half the time. It doesn't mean we're going to lose money, but we're going to go through trades that lose, and so we have to make sure we manage this. Just like a baseball hitter, a really fantastic Hall of Fame baseball hitter has a 300 batting average. Okay, you think about that. That means that, and this is amazing. This is the best of the best. Most of them are less than that. Most of them are 200. Okay? And what all that means is that out of every 10 pitches that a baseball player has coming at them, the best of the best will hit 3 of those 10. Okay, the average will hit 2 out of every 10. So if we're depending on our methodology is looking to extend those trades a lot longer, so our winning percentage becomes a little bit lower. We're right around 41, 42%, but our winners on average have been about 45%, and our losers on average have only lost about 9%. And so we can make money consistently over time, even with a 40% win rate. We're amazing. Okay, if you think of it in terms of this, if 3 out of every 10 for a home run hitter, okay, but we're going to get a whole bunch of doubles and singles and triples and get some home runs in there as well. But the losers, we want to make sure that we don't have that. This average never gets really big. We even had one trade in there that lost 52% this year on a gap down. And that hurts. That was the worst loss that we had so far this year, but the average is still 9%. So we've got a whole bunch that are lost 2%, lost 1%, lost 5%. And then the bulk of those, as they're continuing to win, we want to hold on to that. So the expectation of being right all the time, you just have to get that out of your head. And it's not about being right or being wrong. It's about profiting or losing. Okay. And it doesn't matter because we have no control over what the stock does. We're just simply trying to get in as the trend is moving. We're not going to be right all the time. We're not going to catch that trend direction every single time. And when we're not, we want to make sure that we're out of those trades. Okay, I talked last week about this a little bit as well. I wanted to kind of continue on that line of thinking, but I also wanted to talk a little bit about the risk management side of things as well on trade entry, because as we're going through and we go through this process, okay, the process number one is, and TradersPro is built to be an entire system. It's a process, and you're starting right here. Market trend. What is the market trend? We want to start with that real big perspective. Okay, we want to know this. We want to know what is the trend direction. Okay, we obviously know we're in a bull market. We obviously know we're way higher than we normally get. This is why it's for years and years and years, it would stick right around this 5 and then it'd pull back. Now we're just getting up into these really high numbers, 20s and 30s, 20, not 30s, but upper 20s in these bull markets. And so we're definitely seeing more volatility, particularly in, even since COVID, just kind of the last 6, 7, 8 years, more larger upswings, larger downswings. And that's also a part of more and more people trading in the marketplaces currently. So this is our first step. What's the direction of the market? It's going higher. Where is the trend extended, or is it just beginning? Trend is extended. That's going to change our bias just a little bit, and that changes our allocation. That might also even change whether or not we're making any trades for the day. We may say, yep, we're extended, and we have buy-sell ratio that is less than 1. So I'm sitting on my hands. I'm going to sit on my hands and wait until I get a positive buy-sell ratio. That at its very basic methodology would be your bias going into the trade. Market direction is bullish, we're extended, buy-sell ratio is negative. I'm either going to not make trades, or I'm going to be larger percentages in cash, and I'm going to be a little bit more selective versus a little bit more aggressive. Okay, now I use a wheel portfolio strategy where we're adding into something each day. But now we've got stops a little bit tighter. We're exiting out of a few things a little faster just to maintain a little bit smaller position size because of those two things. Markets are in an uptrend. Their extended buy-sell ratio, pardon me, is less than 1. And so why fight that? Why fight that trend? There certainly are going to be stocks that are moving higher, and we can still, select individual stocks in these market conditions. But if you had in your trading plan and said, I'm not going to buy anything if buy-sell ratio is less than 1, or if red is above green, okay? If that's the only market conditions that I'm going to be trading in, then I might be sitting out some 2 or 3 months at a time. Typically these trends you can see about, this was from August to about October. So this was last summer. We had some negativity, and then going into the fall, we had this uptrend, and then this final uptrend, we didn't get a lot of participation. And now we're kind of seeing negative, weak positive, and then some more negative right here. So these are also telling us the story of all of the stocks, not just S&P stocks. And we want to factor that in. We don't want to be guessing, but we want to be factoring in, how does this affect my decisions for allocation or participation? Am I going to trade anything at all? Or am I going to have some stocks, maybe I go a little bit smaller position size because maybe I don't get the breakout follow through and I end up getting stopped out. My stops on these last few trades have been a little bit tighter where we can do that. And we'll talk about that here as well. So those are really, you're starting with that perspective. Then we can also go into the bond yield curve. Really everything on the market trends tab is about your bias. It's about the market bias. What am I doing and what am I focusing on? Because we also know that the bond yield curve, and the reason I include this is because it is effective in understanding economic cycles. Okay, and we've talked about this before. And if you haven't played around with this, it's kind of fun, but I've used it enough here in these classes that you want to recognize what happens in a good economy. Here, let's go back to 2000 dot-com bubble. We had a big rally. Okay, even as it was starting, clear back here, we really had elevated bond yields. So from 1995 to 2000, we had pretty high interest rates. Both long and short-term interest rates were pretty high during all of this move. So we could potentially continue to see more upside as the market digests the idea that we're going to get higher or have higher and higher interest rates. That is a possibility, but it's not a high probability, because markets typically want to have free flow of capital. High interest rates are preventing that from happening, and that just makes business a little bit harder to expand and grow as money becomes more expensive. Now, as we go into the dot-com bust, we get this equalization, we get this reset of the bond yield curve. Okay, this bond yield curve, now we have short-term interest rates, which are really low, long-term interest rates, which are higher. That incentivizes shorter-term investment and frees up more capital and allows expansion. Okay, so then here's what happens. The stock market looks at that, and then we get the expansion, and we get this same story again, whether we're fighting inflation. In this case, we were fighting the subprime debt and credit default swaps and all of the shenanigans that were happening in the subprime mortgage market. And that was a lot more of a systemic issue. Ultimately, it collapsed, retraced, pulled back, and there we are. Now we're sitting. Look at where these stock rallies begin with a healthy yield curve. This is called a healthy yield curve, where we have lower rates here, higher rates here. Now, as we continue this uptrend, that bond yield curve stayed almost the same till we get to COVID right here. Then the Fed dropped rates next to nothing, if you recall, and handed out a ton of stimulus. So they're basically just flooding the entire country with money, and that money had to go somewhere. Where did it go? It went to Costco TVs. It went back into Robinhood trading accounts. It went into vacations. It went into whatever. It was consumer spending. Well, all of that money flooding the system creates inflation. The prices of goods and services of all of that money chasing fewer goods and services makes prices go up. Inflation is nothing more than a fancy word for the cost of things is going higher. Okay, milk, bread, and eggs go higher. Cars and homes go higher. Everything is going higher. That is inflation. The cost of everything is going higher. Well, that can get out of control. It can spin out of control. And so what does the Fed have to do? They have to remove money from that system. They have to make it so that there is less money chasing those goods and services. And so what do? They raise interest rates. And they raise interest rates in the short term here as well. And that's where we're at right now. And why are we sitting right here? Because they don't have inflation under control yet. It's still 3.5%. And their target is 2%. So I say that not because this is really long-term, super boring economic analysis, but it's valuable to understand where we at in that cycle, where we at in that money supply cycle, where we at in that interest rate cycle, and that can also affect the decision to be like, well, okay, every time that this has happened, yes, we can drift a little bit higher, but at some point we have to get these rates lower or inflation. If the rates don't go lower and inflation remains higher, we're going to get a recession. And then they're going to have to lower interest rates because now we're in a recession. The Fed's in a no-win situation right here because inflation's not under control. So there are some underlying real negatives in the economy right here, and those are kind of scholastic economic negatives that happen really, really slow. And I wouldn't be surprised to see it happen again. That's why this is here, is to help understand where we at in that money supply cycle, where we at in the interest rate cycle, because I may not want to be aggressive in stocks, knowing that that cycle's got to correct itself. And typically when that happens, the economy is retracing, and stocks are also a part of that as well. Then we go into some of these indexes. What are we looking at as far as the indexes as a whole? Do we have buy-sell ratios across the board that are higher or lower? We know that the NASDAQ 100 is about the only thing. We talked about this the other day, and I told you that this bumped up to 12 and this bumped up to 1. And so we had a buy-sell ratio of 12. But this is the story right here. This is the real story, and that's 19. Which direction are those going to go? Back this way or back this way? This bumped up to 12, but now 6 of those went back to hold. Okay, so we know, even just looking at the Dow, that we just have a flattening type of buy-sell ratio. And the NASDAQ 100, these stocks, these 30 stocks are really, and even these 85 stocks in the S&P 500, which are going to include these 32 for the most part, are really what's running the market. That's really what's moving the market higher. And we know which ones those are. Okay, they're going to be, NVIDIA has actually pulled back. NVIDIA is not in this list anymore because it's a hold. It's already pulled back. And so you're getting Microsoft, you're getting Amgen, Intuitive. These are all these big companies, and a lot of tech companies, some medical companies in there as well, also participating. Okay, and then we can move into the individual sectors and talk to say, do we have a healthy market based on sector participation? Not so much right now. It's a little bit weaker. We're at summertime. Oil is moving higher. Interest rates, we even talked about those bonds moving back down a little bit here as well. Looking at this chart, where did I go? I wanted to go right here. So you saw TLT actually pull back yesterday. And so now it's, it's struggling a little bit here as well. So these market conditions are they're just not fantastic. Okay, they could be better, they could be worse. They're kind of this stuck right here in the middle, and we're seeing that and we're going to assign how much allocation are we putting into these individual stocks. So a little bit more economic perspective and big picture perspective to help decide, how do I approach my investment portfolio? Is it going to be a little bit weighted towards cash? Remember, I'm not afraid of cash ever, because I'm not going to be there for very long. And the academic perspective is cash is bad because it doesn't keep up with inflation. Well, not for 3 months and not for 6 months. Okay, even a year, you could sit in cash, because what is cash paying you right now? Cash is paying you 5%. So essentially, of this bulk of money, this 75%, we're getting 5% annually on that money. And then we're trying to get a little bit better performance out of the bulk of the rest of this portfolio here as well. So nothing wrong with being allocated in cash, because that is your safety net. Okay, and I wouldn't move it to bonds. I wouldn't move it to fixed income. It needs to be cash, money market account, checking, savings, whatever most brokerages accounts have a reasonable money market account, and they're probably paying a little less than 5%, but even around 4.5%, which is great for that cash just to be sitting there, to be safe. I'm getting paid for the safety, and I'd rather have that than try and take additional risk. I'm even okay with no percentage gain, 1% gain while I'm sitting in cash, because I'm paying for the lack of movement. I don't want any movement, because I'm going to get the movement here when the time is right. Okay, in fact, most of this gain over this last year has been with around 50% in cash all the time anyway. So risk-adjusted returns, we've got fantastic risk-adjusted returns because we're never fully invested. We've always got a large amount in cash. And in fact, this is not even including any interest rate that might have been gained on the cash as well. Let's jump back. Let's look at some of these other ones here, like NVIDIA. You're seeing some of these names that are pulling back. We're sitting at the 236 support area. So, some of these names, if you're looking for opportunities to add into them, you also want to look at that big picture. We talked about this on Tuesday, that the justification of NVIDIA right here based on valuation it's still probably justified. So I don't know that you're going to see a big collapse here, because it's still based on the last 2 years of performance. It's got a lot of history here on price activity, but it's at a support range, pulling back. We'd want to see a little more confirmation here, a pullback, maybe a retest, and a new confirmation bar to the upside. Where we want to be thinking about this trade is here. We don't want to be thinking about it again here. This is the time that we needed to be thinking. These are the times that we need to be selling and taking profits. A pullback, a stop out of the remaining position, or if it continues to move back up, then maybe we can consider it. But as of now, this is like, well, okay, I'm going to wait. I'm going to have to wait for a little bit longer if I want to try and buy into NVIDIA, to let this current downtrend work itself out just a little bit more right here. Okay, now going in and looking at some of these other names as we're going through and looking for new entries, the new buy signal the new buy tab is a great place to start. Sometimes you do get big gappers, like DAQT had a big run up on earnings, and sometimes those gaps get away from us. We can't necessarily enter into those. I don't always love to get into something that's got a massive run up here as well and a big gap. So you're scanning through those and you're looking for a little bit cleaner bar. Okay, this is not bad, where we want to see a little bit earlier in the buy trend, meaning that this has just barely come out of this hold range and it's gone back to this buy, meaning here it's gone from hold back up to buy. It's not extended. It's early in that trend, and we've got an increasing bar and increasing volume. We want to see the bar that's a little bit better grade versus something that looks like this. Even though it's bullish, you had some selling into that day, and you can kind of see what's happening today here as well. market conditions, or just we may see some floundering of some of these names going forward. Robinhood right here, there's just lots of good opportunities, and this is the location to be looking for them. If we can get into some of those early in those trends, great. Sometimes even early, even as a continuation of the trend, this would be our early entry after the first buy signal, after a sell signal. But we can always get into these along the way as well. We can certainly have, as it's pulling back and still working on that uptrend, be buying into this trend as it's continuing to move higher. I'm going to end on that note. Went a bit long-winded on the front end of that. Hopefully you found value there, and we will pick up again next Tuesday. Thanks, everyone. Have a fantastic weekend, and we'll see you next time.